Welcome to Trademark Capital Management's review of the January 2025 FOMC meeting. I'm Peter Mauthe, and I'll be your presenter today. Let's get right to the slides. The actions that the Fed took yesterday are that Fed funds will remain at 4.25% to 4.5%, and the balance sheet roll-off or reduction will continue unchanged. Their comments during the press conference were that the FOMC sees no urgency to change policy, and the reasons they gave were unemployment remains very low at 4.1% and stable at those levels. Inflation remains sticky and still above the target rate of 2%. Tariffs there are too many unknowns to be a factor in decisions at this time. Taking a look at the dot plot, the latest dot plot as released by the FOMC, shown here in a diagram where the top line is the line representing the high value of the dot plot at each of the calendar year segments. The green line is the middle or the median of the dot plot estimates, and the blue line is the low estimate of the dot plot. As of now, we remain at 4 3/8%, which is the midpoint of 4.25% and 4.5%. And you can see that the mid-range here, we are well above that by half a percent, and are likely to stay there until June of this year, which are when the estimates are that they will lower rates, or at least begin to lower rates again, and the rates will be lower but slower. We'll get to that in a moment. The current yield curve is in blue. The yield curve a year ago is in black. And you can see to the left here, indicated by the letter A, that the Fed has dropped interest rates on the short end, which is the only rate that they control, by a full percentage point. But you can see in the process of lowering the short end of the yield curve, the long end of the yield curve has actually gone up since a year ago. And the green dashed line here represents the typical slope from 30 years down to 1 month of a typical yield curve. It is estimated that the Fed will lower rates by another full percentage point over the next 2 years. And if so, you can see that if the normal yield curve slope comes in, that we can expect the yield on short-term debt instruments to come down further over the next 2 years, while the longer rates starting at about 3 years and on out are unlikely to change much at all. That means car loans and home mortgages are unlikely to see the same type of decline over the next 2 years that we'll see at the short end of the yield curve. What does this mean for investors? It means that interest rates are going to be lower but slower in the short-term end of the yield curve, likely with decreases to start once again in June of 2025. There will be little change in the 5 to 30-year end of the yield curve. The potential will be about the same as we announced after the last Fed meeting, at about 2% real GDP growth for the foreseeable future. The potential is for the dollar to remain strong because we will have relatively high interest rates compared to the other developed markets of the world. And we'll also likely see increased volatility, uncertainty in the stock market. Now, all of these things make for some concern for investors who have a buy and hold portfolio and no dynamic feature to adjust to changing market conditions. We're likely to see a good bit of volatility in economic policy, interest rates, and in earnings throughout the course of 2025 and into 2026. Here at Trademark Capital, where we have actively managed portfolios, we constantly monitor these changes and adjust portfolios accordingly. You can follow us on X, YouTube, LinkedIn. You can also review our archives at trademarkcapital.com, and you can reach us at info@trademarkcapital.com. Also, if you have any suggestions for future videos, please don't hesitate to contact us, and we'll try to get such a video recorded and out within a few days. Thank you for joining us today.